Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. In the week that Donald Trump returned as US president, we begin the show, perhaps inevitably, by looking across the pond. Full-year figures show US banks continuing to fire on all cylinders, so we're doing a bit of a compare and contrast with their UK peers. Jemma Slingo is here to discuss what the year ahead may hold. Our cover story this week looks further out. In it, Alex Newman examines the outlook for the major asset classes over the next 5 years, insofar as such things are possible. Alex will be here later in the show to give his thoughts. To wrap up, we will look at the future of the biotech sector, the possibility of big M&A deals there, and we're also going to examine why the big weight loss drug purveyors, Eli Lilly and Novo Nordisk, have seen their shares crater in recent months. Julian Hoffman will talk us through that. Let's begin with the banks, though, and I should start by saying we have newly expanded our coverage of US companies. We'll be giving regular recommendations on all the major names among the 50 largest US businesses from now on in print and online. There are several banks among that cohort, names which will no doubt be familiar in some form to most of our listeners, the likes of Bank of America, JP Morgan Chase, Citigroup, Morgan Stanley, etc., etc. Gemma,
Yeah, lots of share price gains. I think what's been driving a lot of the excitement seems to be the investment banking side. So we've had a couple of years of really subdued activity. People have blamed it on higher interest rates, sort of more antitrust challenges, just general sort of geopolitical chaos. So there's been a couple of really tough years for these investment banks, but now in the fourth quarter we've seen this real resurgence in activity, which seemed to have got investors quite excited, which is good to see at the start of the year.
you covered a couple of the individual results as well. JP Morgan, perhaps a particular standout. It always seems to be a standout, or certainly over the last 15 years or so, but once again looking like one of the strongest.
Yeah, so JP Morgan is Wall Street's biggest bank and it does a massive array of things, but generally everyone was very pleased with its results, particularly on the investment banking side. But across the board in the final quarter, net income was up by 50% at $14 billion, which gives a bit of a sense of its huge scale. But I think, it wasn't just JP Morgan that people were happy about. There was Morgan Stanley, which again is known for its big investment banking business. And that seemed to be also very well received by the market. So I think just generally there was a real sense of enthusiasm.
We'll come to the UK comparison shortly, but maybe I can just quickly bring in Julian just to give a quick view on Bank of America and Citigroup, where perhaps slightly contrasting fortunes within this overall context of things going quite well.
Yes, it's an interesting split that Gemma sort of alluded to there. Basically, the two banks that we've added to that list, Bank of America and Citigroup, are slightly different entities. They don't quite have the same leverage in the investment banking side of US banking as the others, but they have different strengths and they're performing in different ways. So Bank of America is a very big credit card and mortgage lender in the US. Probably, if you had to strain it, probably the second largest retail bank on its own terms in the US. And it has a lot of its own branded credit cards, which is what people are lending against at the moment. And it's doing very, very well in terms of credit card and mortgage lending. So the market was pretty happy with that. And it's given it a relative premium PE of about 12 and a half, which isn't bad really for a kind of a retail focused banking operation. The one that's more problematic in an all-round sense really is Citigroup. Citigroup, for those with longer memories, had made massive losses back in 2008, and it's had a similar restructuring process to, say, NatWest here in the UK, and gone through many years of tidying up, restructuring, and all that business. And it's at the point now where its basic profitability has been called into question. the CEO who's now been there for 4 years, and she has promised that the group will drive through a kind of a $1 billion efficiency program this year and next year. And the reason for that is that the return on the company's equity, common equity, they use a similar ratio to ROCE, but slightly different. They call it common equity in the US. Is only about 7.5%, whereas the standard bank in America is making about 12% on its common equity in terms of returns. So Citigroup is a long way behind everyone else in terms of profits, in terms of how well it converts its revenue into profits. And with that in mind, the management is under pressure from investors to deliver, but to close that profitability gap. So that was the basic thing of the results when they came out.
Let's bring in the UK angle, because we haven't forgotten the UK, far from it. We're still covering the exact same number of UK companies as well. The US is just a little bonus, but clearly listeners will be more familiar with the UK banks. But Jemma, what are some of the broad brush differences between the two sectors, if we can boil it down on such terms?
I think when you're looking at the UK, and you'll see this in our coverage, a huge amount hinges on net interest income, which is essentially the difference between what a bank earns on its loans and what it pays out on its deposits. And underpinning a lot of that interest income are mortgages. So when you're looking at the UK, you're thinking about the housing market, you're thinking about what are people doing with their money on sort of a retail basis and a commercial basis. Um, but when you look at the US, as we've just been talking about, investment banking is a big, big driver of growth. Um, and obviously, what drives investment banking is quite different, related, but not exactly the same as to what, you know, drives a house purchase or a company loan. So I think those are, from a revenue mix perspective, important things to think about. Also, just the scale of the US is almost incomparable to the scale of the UK. So I had a quick look before I came on. JP Morgan has a market cap of just under $750 billion, whereas at NatWest it has a market cap of 35 billion. So it's almost, you're not comparing like with like at all. But from a profitability perspective, US banks have historically been more profitable than both UK banks and European ones, which is obviously something investors will want to think about, and has driven a really big valuation gap between the two regions, which hasn't shown any signs of closing yet.
Mm. That said, it was, of course, a very good year for UK banks last year as well, share price wise. But some of these gaps could get a little bit bigger in the near term rather than smaller, not least the regulatory one, because the 45th and now 47th US president has promised or has committed to a variety of deregulatory moves, as you might expect, given his views on such things. Therefore, from the banking sector in particular, they're looking at capital requirements being loosened, things like that in the US, which again might give them, well, from shareholders' perspective, in the short term, a bit more oomph. In the long term, who knows what trouble they might get into. But yeah, again, that may be a bigger point of difference in the near term as well with the UK, with Europe.
Definitely. I mean, banks generally seem extremely enthusiastic about Trump's return. It's one of the reasons it's been given for this big uptick in deal making. But as you say, there's also a lot of talk about deregulation. One of the big points of interest at the moment is something called Basel III Endgame, which sounds very exciting, but it basically relates to how much capital banks around the world are required to hold. And in theory, it should have quite a big impact on the biggest US banks. But gradually, it's been watered down and delayed. And now there seems to be a question of whether it's going to be introduced at all under Trump. And if it wasn't, obviously, banks could then use the capital they were required to hold to fuel profit growing measures. So there would be sort of a burst of enthusiasm, I would have thought, if suddenly it came about that those new requirements were just going to vanish. And one analyst I was speaking to did seem to say, the difference in approach between the US and the UK is very pronounced at the moment. And if it gets bigger, the valuation gap between the two regions is likely to get bigger too.
That said, we have seen a bit of a deregulatory angle emerge this week in the UK in the case of the motor finance issue and the commission mis-selling or purported mis-selling that we've discussed on this show before. The government looking to get involved with that case to the benefit of the banking sector, potentially, we hear.
Yeah, it's quite an unusual one, actually. So the Treasury has sought permission to intervene in a forthcoming Supreme Court case, and the Supreme Court's basically going to decide whether the Court of Appeal was right to crack down as hard as it did on the motor finance market. And Rachel Reeves has basically waded in saying, this could have a really big economic impact if suddenly banks are on the hook for billions of pounds worth of compensation. But then obviously in the UK, there is still a very clear divide of powers between government and courts. So it'll be interesting to see how it plays out. The Supreme Court case is due to be heard at the start of April, so presumably it will all start kicking off in earnest in the spring.
We have already, in response to that, it's just a FT report so far, but we've seen some quite big share price gains, certainly for Close Brothers, which was clearly bound up in this quite tightly, and Lloyd's to a lesser extent as well. So there is some enthusiasm from the market for this move. Let's look at the outlook for the year on the whole. In the UK, you mentioned net interest income. There are differing views on what happens with interest rates this year. If the economy continues to deteriorate, we may well get more base rate cuts than are currently being priced in. But that said, given the hedging programs in place, the outlook is still set okay for UK banks.
It seems to be. So analysts seem to be thinking that even when interest rates start coming down because of something called structural hedging programs, net interest income at banks will keep going up because those programs essentially sort of delay the impact of interest rate moves. So that seems very positive. I think there was a big sigh of relief at the autumn budget that Labour didn't introduce this massive banking tax, which would have really knocked confidence in the sector. So yeah, I think there seems to be a lot of enthusiasm there. And if interest rates do start coming down, we're likely to see a bit of a bounce back in the housing market, which again will drive up those loan books.
And in the US, a similar story in terms of the extent of the optimism, albeit for slightly different reasons, perhaps a stronger economy, deal making.
Exactly, yeah. It does seem to be the focus is on investment banking over in the US.
Indeed. Well, we're going to set our sights even further out now, looking at the rest of the decade, effectively. The cover story this week is a 5-year outlook. Alex, you wrote the piece. Can we talk about the context for that, other than the fact we are halfway through the decade right now, and it's an opportune time, perhaps?
Well, I suppose it's partly prompted by the kind of annual forward look that every investment bank, every magazine or investment publication like ourselves undergo each sort of December and January, where we sort of fix our eyes on where things are going to end up by the same time next year. And we also do know that the further out we try and forecast, the less accurate we are likely to be. So there's a lot of sense in almost restricting our horizons most of the time to a 1-year view, because markets and economies are made up of so many variables that trying to correctly gauge where, say, a stock's price is going to be in 3 years or 5 years time is less likely to be accurate than a 12-month forecast. Maybe that's a fairly obvious point, but the other thing to say is that unless we are trading week to week or day to day, we do have to think long term. And 1 year outlooks are all well and good, but if you're managing your own pension or your a stock portfolio, it's likely in the service of a longer term goal than 1 year. So like it or not, it's a very hard job. As I sort of reminded myself when writing the piece, looking at asset projections 5 years out, but we still have to try and fit a view, or our view of the investment landscape around the longer term. And there are ways we can do that doesn't just feel like embracing chaos. There are plenty of things we can try and pin our faith on.
Before we continue to look forward, let's look back, perhaps in a way, and look back at previous predictions, because in the piece you talk about Robin Parbrook, as Schroders fund manager, and some predictions he and his colleague made at the start of 2020. We also talk about some of the predictions which, from today's vantage point, even though it was only 30 years ago, look pretty wildly inaccurate, to say the least. So can we talk a bit about some of the things people have predicted in the past over the long term.
Yeah, and it just goes to show it's a demonstration of how hard it is to predict over the long term. So the wildly inaccurate one you're referring to was something I wasn't aware of until researching the piece. So at the end of the 90s, America managed to balance its government spending by taking more in tax revenue, etc., than it spent for the first time in something like 30 years. So the Congressional Budget Office, which is this US body charged with extrapolating the federal budget implications sort of 10 years into the future, which is precisely the sort of time that the investors are often thinking about, how am I going to manage my exposure to fixed income or equities, etc. Will be thinking. Their projection was that that these growing surpluses in the years ahead would effectively mean that America could pay down its debts within a decade. I mean, now we know what happened. That obviously didn't happen. Government borrowing has exploded over the last 25 years. But people, sensible people were really wondering what the world was going to look like without US treasuries. And I suppose what that shows is the danger of extrapolating a change which, at the time that, there were good reasons why the CBO might have thought ahead and decided that this was a new era for the way governments manage their finances. It's a little bit like seeing the sun shine today and decide it's going to be sunny for the rest of the year. We know that the weather is variable and the economy is a similarly complex multivariant system, and democracies have lots of competing claims on spending. So it's hard to rationalize that CBO forecast other than kind of unbridled optimism, which we are all guilty of at certain points when sentiment is so positive. And yeah, the other example that I looked at, speaking with Robin Parbrook at Schroders, he and his colleague put together these sort of 15 possible scenarios about how the world would look like at the end of this decade, which, this is not unusual crystal ball gazing like fund managers, investors do it all the time. But it was interesting just looking back with 5 years of hindsight, how you can get some extrapolations which were existing trends already. For example, manufacturing falling as a percentage of global GDP, and how you can build that into some of your investing decisions. And that's continued. That's not a huge surprise. Others, for example, oil peaking, I think was one of their projections in 2019, which I think from the perspective of 2020, it looked like it might have done. And those big long-term secular trends, you think, okay, this is going to be the start of something forever. We now know that didn't happen, and that was almost a mirage created by the pandemic. So yeah, just a couple of past examples about how to think about the future, or how you're probably going to get it wrong in some senses.
Sometimes things can change more quickly than we think. Sometimes it takes much longer. I mean, I've probably defined by writing about it at the time, but I always think we're still dealing with the fallout of the 2008 crisis even now.
Yeah.
Which is, I suppose, a bit like the, what's his name, Chinese Premier Zhou Enlai, when that old quote about when Nixon asked him in the 70s for his summary of the conclusions of the French Revolution, he said it was too soon to say. Albeit, apparently, that may have got lost in translation, and he thought he was talking about the 1968 conclusion.
Okay.
But anyway, it's useful as a quote for our purposes. Do you think it's particularly difficult to make predictions at the moment, though, getting back to the present day? You cited some points from BlackRock in the piece talking about, we're not in a business cycle at all, never mind where we are in the business cycle, which is something people have said coming out of the pandemic and how that's kind of shaking everything up. They say we're in a very unusual environment, which feels like a caveat we could have used at any stage over the past.
Yeah, well, I think their exact words were, we have more conviction that we are in a very unusual moment, which sounds very authoritative, but it could just be a very fancy way of completely copping out of a real answer. Yeah, I mean, that's probably one of the more unfair questions you could ever ask someone, because you're I suppose you're asking whether the available information we have and our capacity to interpret it and read from it lessons or directions that we're heading in has degraded relative to what exactly. I mean, it's there are lots of things going on there, but like if pushed, I would say yes, probably, because and to be charitable, I suppose, to BlackRock, what they're saying, there's one part of what they're saying which is this argument that we don't just have supply and contraction in the business cycle anymore. We have these mega forces that are riding sort of roughshod over over normal market indicators. So to take one example, we had huge spike in inflation, and many people were predicting that the the the, the sharp rise in interest rates were going to lead to a recession, and that hasn't happened. And the US, the world's most important economy, it's just continued to fire on all cylinders with inflation and the pain that causes, lots of people notwithstanding. And it looks like from this week that's just going to continue, really, that Trump is just doubling down on anything that could cause a sort of sugar rush to the American economy, but potentially there's lots of inflation effects there as well. The other part of it, I suppose, is what makes long-term forecasting so complicated at the moment is that there's a growing awareness that there are so many uncertainties, whether it's I think we feel like there was a lot of unprecedented sort of social and political change that's unfolding, but also we've got this huge colossal technological potential, or not, discuss whether AI is going to revolutionize everything. We've got huge and growing debts at the same time, huge near-term unknowns about how climate change is going to affect us all, and the geopolitical tensions that have probably been more than the pandemic the dominant story of the last 5 years. So it's a really complicated world, and I think that's one way to translate what BlackRock is kind of saying there.
Mm. I should say at this point, perhaps we have, or you have tried, despite all of these issues, to distill down at least one salient point for each asset class looking at over the next 5 years in the piece. We won't go into all those points. We'll save that for people who pick up the piece or have a look online. But maybe we can just talk about one of those assets and your thoughts about how things might unfold in the next 5 years or so.
Yeah, I mean, we could talk about gold. I think there's a couple of things to say about gold. At first, and I was unaware about this until I looked at it again for this, that in recent decades it's been one of the best assets you could have held in your portfolio. So if you had bought gold at the start of the century and just left it be, it would have outperformed the S&P 500's total return, which we look to that as almost the North Star of investing returns, and it's beaten that. So it's not a cash generating asset. There's no, unlike stocks, bonds, cash or property, you're not getting a return on it. So it is the kind of asset that people think about in a long-term returns kind of framing. So you should think of it over the long haul. And I suppose the other thing you can say about it is that it does fit quite awkwardly in a portfolio in some ways, because when we think about asset allocation, it's 60-40. Is it 30% of your wealth in property, etc., etc. And unless you run an extremely concentrated portfolio, we're not often talking about 30% in Unilever, for example. But if it's worth talking about gold, then, and I think it's only worth talking about it as a relative scale, if it is something you're going to own, then people get instinctively nervous about holdings over 10 or 20%, because it is volatile. It is its own asset. It's not correlated to lots of other things. But anyway, so the argument for it, and the reason why I say that if you don't have a position in gold, maybe consider building a small-ish position, see where it goes, is that over time, and one of the ways to account for its price growth over the last 25 years is that its scarcity does have value relative to the value of money, which looking at the growth in the M2 money supply since 2000 from the four largest central banks, it's increased by something like $16 trillion to $89 trillion. So without going into the sort of like the rabbit hole of currency devaluation and government interference with our money, I don't think it's a huge reach to say that gold has held its value a lot better than fiat currency. And that's when you're looking for diversifiers within a portfolio, that is, and you're maybe you're very worried about the geopolitical situation of the next few years, and how currency debasement is going to play out, and how inflation is going to affect things, then I think gold has proved itself. And we don't talk about it a lot because there's in some ways not a huge deal to say, but that doesn't mean that we shouldn't occasionally make the case for it. And I think there is a case for gold over the next 5 years.
Yeah. as you say, it's not just the past couple of years, a big surge. Those long-term numbers are quite compelling as well. We're going to turn to our final segment now, though, which is about biotech and cutting-edge drugs, if you will, including weight loss drugs, which we'll come to in a moment. But let's start with the upstarts of the industry, if you will. Julian, this is partly based on the big annual JP Morgan conference, which has recently been held in San Francisco. Also partly based on the amount of deals we're starting to see emerge in the sector again. What are your thoughts?
Yes, that's right, Dan. The JP Morgan Healthcare Conference in San Francisco is kind of a cross between a beauty contest and a trade show for the pharma industry every year. It's the start of the year when everyone unveils their data and the deals they're making, and it gives investors a very good idea of the strategic direction that companies are taking this year. In each of the previous years, it's been quite disappointing in terms of the number of deals, that both in absolute value terms and in quantity. But it's noticeable that this start of the year, there's been a pace of deal making which we haven't seen for quite a few years, including some quite big individual purchases by the large pharma companies. This is all about restocking pipelines in various therapeutic areas. So we're seeing about 20 billion worth of pharma deals so far in January. The biggest being a Johnson & Johnson acquisition of a specialist oncology company. They all seem to be based in Massachusetts. This seems to be a biotech hub at the moment. We are seeing an uptick in deals, which is quite positive. It reflects the fact that pharma companies over the past few years have been generating excess cash. For the aftermath of the pandemic itself, and for certain companies was very profitable in terms of medicines shifted, and the result of that is they now have cash to invest in the next generation of medicines for their pipelines. So that's exactly what we're seeing now, and the likes of GSK as well are taking part in this. GSK recently acquired a gastrointestinal drug, IDRX-42, for over $1 billion. The interesting thing about that was that it was a very early stage medicine, so the data was only for phase 1-2 trials. Normally, they would buy on the basis of at least late stage 2, if not early stage 3 trials. The thing now, the buzzword now in pharma is about specialized or personalized medicine, the opportunity to almost genetically match a person with the specific therapy and to adjust the therapy so that it makes it much more effective. We're heading into a different type of, we're moving on really from what were biological medicines to almost personalized medicines, which is quite an exciting development in some quarters.
This is all in the context, isn't it, of the focus of pharmaceutical companies, or certainly pharmaceutical investors the past 2 years, has been very much on the weight loss drugs, the huge appetite for those, no pun intended, the way companies are trying to compete with Novo Nordisk and Eli Lilly. But perhaps the recent events have shown that it's important to diversify because, as we've been alluding to throughout the show so far, both Novo and Eli Lilly have seen share prices really come back quite a long way in recent months, drop right back down, or at least retrace about 50%. Can we talk a bit about that, maybe the factors behind that? There are a lot of things in the mix here, whether it be manufacturing constraints or target market concerns, or whether it's simply the fact that they were priced for perfection at the middle of last year and that perfection has not quite been delivered.
Well, I mean, the valuations were a bit porky, to be honest. The issue with weight loss drugs, as you've alluded, is that any minor setback has a massive impact on the share price, because the shares have been run up or bid up to levels which we haven't seen in the pharma industry in absolute terms ever, I don't think. Novo Nordisk alone has lost $120 billion worth of market value. I mean, it's incredible, really. But the issues that they are running into, and this goes for US company Eli Lilly as well, is that they've got two basic issues. One, Eli, for example, is not selling quite as much of its weight loss drug as people had expected. I mean, it's not a massive miss, but it's a miss nonetheless. And Novo is struggling to get the second generation of drugs onto the market. So it had a product called Cagrasima, which it marketed as having a 25% impact on weight loss on people's body mass. And that came in at 22.5%. So it missed the sort of the headline trial data that they were expecting, and that's what has led to the fall in those share prices. The problem for investors really, it is a space that is becoming very crowded. I mean, when you look at the number of drugs that are in phase 3 development at the moment, and this includes drugs by from the likes of Pfizer, which are going to be orally administered. They're going to be easier to take than the injectable drugs that are now on the market. It's becoming a very crowded space. So there's a sense that Novo and Eli won't have this area to themselves for very much longer. And there's a worry now about how that will impact on their basic profitability. But they, in a sense, at the moment they can't make enough product to sell it. I mean, Novo is already Denmark's biggest taxpayer on the back of Wegovy here or Ozempic in the US, and there's a definite worry about whether it could meet even existing demand with its current facilities. So it has this strange paradox of perhaps in the future not being quite as profitable as it is at the moment, but then at the moment not taking full advantage of that level of profitability. So there's a lots of factors at play all at the same time. So this is why everyone is suddenly getting very worried. But I mean, fundamentally, people have overbid the shares by a magnitude of perhaps 2 times. So that's the reason why it's falling so much.
Yeah, as you say, there are a lot of things in the mix here. Novo and Eli Lilly, clearly the early pacemakers. Some recent trials suggested that Eli Lilly's, I think it's Mounjaro, one of their brand names, Zepbound is the other one, was slightly more effective than Novo. So then this trial came in December where Novo's next generation was really hoping they could at least show they had the edge. That didn't happen. I mean, it sounds on the surface quite a narrow miss, doesn't it? If you're hoping for 25% effective weight loss and it delivers 22, and yet that was enough to send the shares down 20%. There was
I mean, 2.5% in pharma terms though is like a massive gulf. If you talk about statistical significance at 0.21 or something, and then if a 2% miss is a massive moonshot. The problem is that they can't. There's no way they can really win on this because people are saying, "Oh, you could have structured the trial differently." But if it doesn't deliver what it says on the tin, then I mean, no amount of restructuring. You could have had a blind arm or something to the trial, but there's no way that you could make up that difference. I don't think. I mean, and I don't think Novo are bothering really to take it in that direction. I think they'll just bring it out as it is, which is, to be honest, a very effective weight loss drug. And I mean, those of us with longer memories can, go back 20 years, and there were weight loss drugs in development, but they were awful. I mean, some of the side effects were just extremely gory and horrible. So the point where we're at now is actually very positive compared to those. I mean, I think it's the only time I've ever had to write oily stools in copy once for someone's weight loss drug in the early 2000s.
Yeah.
The problem is the valuation that people put on it, and Eli Lilly is also suffering, but they have at least this lead in oral weight loss drugs, which at the moment Novo doesn't. So they may, if anything, have a slight edge, I would say.
Yeah.
But then the question then is, how big is the market ultimately when everyone else is moving in so quickly?
Indeed, it does seem like that will be the next stage, doesn't it? Who will develop the most effective oral treatment, which potentially might be quicker to manufacture as well. The point about side effects is also quite pertinent. I mean, that might be the reason why Novo structured this trial as they did. The thing people are focusing in on is the fact that not that many of the participants, proportionally speaking, took the highest dose in the trial, and there's speculation as to whether that was because it was just working fine as it was, or whether they were fearful of the side effects. I mean, if you go to America and they are spending, these companies, a lot on advertising as well, you see these ads on TV, and of course they always, as with every drug ad in America, the end of the advert is
Yeah.
about 2 full minutes of possible side effects, and it sounds horrific. But there we
Yeah,
go.
that's right. Yeah. Unexplained, are a matter for the courts, aren't they, usually at the end?
Yeah. But
Yes, the thing is, though, that side effects are, even with Wegovy or Monjaro as they are, only 1 in 10 people who take it have any side effects at all. Not least the whole list that they have. So you'd be relatively unlucky, I think, to have really bad
Yeah.
side effects. But
Yeah.
if they can market one that has none indicated at all, then obviously that's the promised land.
Indeed. Well, we should we'll keep our medical opinions to that level, perhaps that broad conclusion, because that is the conclusion, because we have come to the end of the show. We've run out of time, but thank you very much, Julian. Thank you to Alex and to Jemma as well, and to our producers, Andrew and Maddie. We will see you next time on another Companies and Markets show.